Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll take a look at will be the Australian dollar. There it is. Aussie looks like it's on its merry way down to 70 even. A little bit longer term perspective, pop out to a weekly chart. You'll see we actually have pretty good resistance down there. You can see where that's coming from. That long-term trend line, that really long-term 66% retracement, so 70 even, likely downside target for there. You know, the short-term story here with the Aussie has been problems in China. You had the problems with the Chinese stock market. Let's take a look at that, the Hang Seng Index from a longer-term perspective. And there it is. When you see it from a longer-term perspective, you see, well, that's not a problem at all. If anything, that's just a normal retracement. If you go back to the 2009 low, and you can see you're still quite a bit higher from there. Even if you look at the last 2 years in the Hang Seng Index, that's a normal retracement. So we think once the Hang Seng Index stabilizes after this much needed correction, China overall, the Chinese economy overall probably having a much needed correction also. Once things stabilize, once the support holds, they start to turn higher. We think that's going to be definitely supportive of the Aussie dollar longer term. However, back to where we're at now, Monday morning, what's happening right now, you're in a downtrend. You're in a nice clean downtrend, so we'll continue to look to sell rallies in that market. However, every now and again you want to pop up and take a look at the big picture there, and we think 70 even going to be long-term support from an investor standpoint. So short-term, intermediate term, keep selling rallies. Longer term, that's going to be a potentially very interesting setup from an investor standpoint. Dollar Swiss, next market. I'm a broken record on this one. What I was saying a month ago, that hey, you have excellent risk reward in this area. Very, very low risk to be buying a dip, potentially a nice reward, and that's definitely the case. Look at those dips. Perfect. They dipped right to support, and now you have a nice uptrend. You have a nice lead on that, so we would definitely encourage you to continue to hold cash positions in here, continue to buy dips in this market overall. Resistance up above, that's a pretty big nut to crack there. You've got that intermediate term secondary resistance, I guess we'll call it, just below 98 the figure. Once that goes, we think you're just going to see a slow, steady rise higher that's really going to be beneficial to holding those long-term cash positions. So, you know, if it gets above there, it may not wait, it may not be so easy. I guess the point I'm trying to make, you may not get those nice dips anymore once it does clear that level. So that's going to be one to watch for sure. We're still bulled up on the US dollar, so we're definitely still bulled up on Dollar Chief here. Here's the dollar index itself. Similar, you have resistance just above. You know, it's interesting time of the year too. You're getting into the dog days, so we can't just assume that it's going to break through that resistance. Obviously, if it does, long term, that's going to be great for us. We've been bulled up on this market for a long, long time. We think that it's inevitable. You're going to see higher interest rates in the United States. It's almost inevitable that the U.S. economy will continue to pick up. And when we say that, based on the rising savings levels in the United States, the rising home prices in the United States, and the U.S. economy is still the largest retail market in the world by a stretch. It's really just a bet that things will remain the same here, which from our perspective tends to be a good bet, right? So we're still long-term bulls on the dollar index. From a shorter term perspective, you want to be a little bit careful and let it clear resistance here. You're probably going to see two-way trade. Speaking of two-way trade, this will make my point here. July was a very good month for me as a trader because I was participating in the trend on the way down there. Boom, boom, caught both those legs. But then I stepped out and I participated in that counter trend move higher there. So that was pretty interesting. And why did I do that? Well, you see it right there. Look at that long-term support, that intermediate term secondary support. That held. So when you see the longer-term support holding like that, you had a pretty good inclination that you're going to get that short-term pop-up too. And more important right now, look at your kind of pin between support and resistance, and you really don't hear me talking about that much, that short term, but that's definitely relevant right now because you're in the dog days. So you kind of got to be careful. I'm on the sidelines now. Actually, I'm not going to be with you the next 2 weeks. We're going on vacation, taking a nice break in the markets. There's generally a reason why I time it that way because of the dog days. So long term, maintain your overall positions, but be leery of the short term of trying to trade. in there because you're going to see the volume shrinking. When the volatility does come, the markets will tend to overshoot themselves because there's not a lot of volume in there. But overall, we think you're going to see shrinking ranges, shrinking volume this time of year. So as a shorter term trader, you want to be mindful of that. Gold market, there's the gold market. You pan out overall, and we've been saying this for the last 2 years that you're in a bear market, and there you definitely see the pattern of lower highs, lower lows, lower lows. Gold collapsed nicely for us the last couple of weeks there. Shorter term here, you can see on a daily chart, you're trying to sow support in at 180 or so. Gold's not a bad forward indicator for a lot of these markets, so that little head and shoulder bottom potentially in the gold could spell more counter trend action for a lot of the financial markets. I think the problem with gold is, does it remain relevant? You know, demographics are so important to markets, and demographics are so important overall, because when it comes to demographics, your largest employees out there are the young people. Your largest consumers out there are the young people. And really, when it comes down to it, though, the young people don't have a whole lot of interest in gold. So I think the question for gold going forward will be, is it relevant? I know from experience, looking back the last couple of years, and certainly even beyond that, that gold was a pretty good forward indicator. But you got to wonder how relevant gold will become going forward. You have support here. We think you're going to go lower still, but the here and now wouldn't surprise me if the market makers were able to stage a dead cat bounce here, a short covering rally, just to run shorts out there and be able to get themselves back on the short side at more advantageous levels. Last market we'll cover will be U.S. interest rates. Here's the 10-year note. Basically, when this market goes higher, that means interest rates are going lower. When the 10-year note goes lower, interest rates are going higher. So currently, you're in the midst of a rally here, but look at that, you're right in a sell zone for us. So overall, we'd be looking to sell into this rally in the 10-year. You're looking at our zone, our sell zone there, the orange box. Overall, we think that zone will hold. Short term, it probably is going to make for some choppiness, particularly if you punch out a higher high here. If you punch out a higher high here, that's going to probably create a little bit of volatility in the market. That'll support a short covering rally in the euro, long liquidation of the dollar, short covering rally in gold, etc. But we think it's just a short-term occurrence, potentially typical dog day behavior in the markets. And overall, you want to be a seller of the 10-year note here in anticipation of higher interest rates of this market going south, which we think will definitely be fueled by Federal Reserve action later this year. Hey, thank you so much. Once again, I'm going to be on vacation for the next 2 weeks, so we'll pick you back up towards the end of the month.